Most companies have several operating cycles within a year. The operating cycle is the time from when we purchase inventory to when we receive cash for the sale of that inventory. Some companies have very long operating cycles and others have very short operating cycles. It just depends on our industry. Operating cycle is one of the things that we look at when we're doing financial analysis of a company. Is their operating cycle increasing? Is it decreasing? Because this speaks to the amount of cash flows that they have available to pay their liabilities. We also look at the relationship between current assets and current liabilities. This is because our current liabilities need to be paid within the next year, and we need to make sure that we have the cash available within our current assets to pay those. Sometimes we look at the long-term risk. It really depends on what we're analyzing these financial statements for. So if I'm just looking for what the liquidity of a business is to pay their current liabilities, I'm going to focus on the current information. Where if I'm looking to give them a 30-year bank loan, I'm going to look at their total assets to their total liabilities. Now we're going to talk about financial ratios. And financial ratios are a way that we do financial statement analysis to look at very different things within our financial statements that are outside of our trend analysis and our comparative percentage analysis. So the financial ratio gives us a lot of different information. As I said, we have several ratios that we're going to be talking about in this chapter. When we look at financial ratios, we want to really look at one, what's the trend in the ratio over a period of years? As I said, we generally want to look at 5 years of information for a retailer. What is our type of business? What is a benchmark that we look at? How do we compare with others in our industry that are similar to our size and the type of business that we are doing? When we're looking at a business, we're looking at it very differently. So for our credit risk and the law, if we remember that the owners of corporations are not personally responsible for the liabilities of the business. Where in a sole proprietorship and a partnership, we are personally liable for any and all debts of the organization. So creditors that are going to be lending us money, if we have a sole proprietorship or a partnership, they usually look at the financial position of the individual owners rather than the financial strength of the business itself. But with a corporation, creditors are looking at the business entity because that is what's responsible for repaying those claims. The liquidity of the business entity is much more important if the business is organized as a corporation than if it's organized as a sole proprietorship or a partnership. Now we'll start working through each of those different ratios. The first ratio is working capital. Working capital is a measurement of current assets to current liabilities. So it's the excess amount of current assets over current liabilities. This shows that we have strong liquidity and ability to meet our current obligations. Next is the current ratio. The current ratio is current assets divided by current liabilities. When we're looking at this ratio, we're looking at our ability to pay short-term debt. This is also a liquidity measure for looking at companies. The acid test ratio is similar to the current ratio. This is also called the quick ratio. So The current ratio includes all current assets, but the asset test ratio removes inventories and prepaid expenses because it recognizes that inventories and prepaid expenses might not be able to be converted to cash very quickly. So with the quick ratio, we look at cash, short-term investments, cash equivalents, and current receivables divided by current liabilities. Then we're going to look at our accounts receivable ratios. First, we have the accounts receivable turnover. This tells us how many times a company converts its receivables into cash each year. So with accounts receivable turnover is our net sales divided by the average accounts receivable net. So the average accounts receivable is our beginning accounts receivable plus ending accounts receivable divided by 2. So if we had 2 years of financial information, say 2016 and 2017, we were trying to determine the accounts receivable turnover for 2017, we would take the net sales from 2017 and we would take the accounts receivable from 2017 and the accounts receivable from 2016, add them together and divide them by 2 to get the average accounts receivable. If we don't have 2 years of information, then we just use the accounts receivable amount available to us. We also look at the inventory turnover. This tells us a very similar thing. How many times our merchandise is sold and replaced throughout the year? The amount of our inventory turnover varies depending on the kind of industry we're in. We would expect a grocery store to have a much higher inventory turnover rate than a car dealership. The inventory turnover is the cost of goods sold divided by our average inventory amount. Another accounts receivable is the number of days our sales are uncollected. This tells us, on average, how many days it takes for a customer to pay us cash for a credit sale. So this is our accounts receivable divided by net sales times 365. Some accounting textbooks or accounting transactions use the accounting year, which is 360 days. Your book and Connect will tell you how many days you should use, whether it's 365 days or 360 days. Also look at the days sales in inventory. This tells us on average how many days inventory sits at our business before it is sold. This is inventory divided by cost of goods sold times 365 days. Another ratio is total asset turnover. So total asset turnover is net sales divided by average total assets. Again, where the average total assets is our beginning total assets plus our ending total assets divided by 2. This shows how well we use our assets to generate sales. This is a measure of operating efficiency. The debt ratio looks at how much debt we have compared to our total assets. This is a measure of our ability to pay our total assets. So this looks at our total liabilities to total assets. So we take total liabilities divided by total assets to calculate the debt ratio. For our debt to equity ratio, we take total liabilities divided by total equity. This shows us what portion our assets are contributed by debt versus the amount you contributed by equity. So how are we financed by debt versus how are we financed by stock sales? Larger debt to equity ratios show that we have less opportunity to expand through use of debt financing. So we have a lower ability to take on more